Execution, not analysis, is sometimes the reason why traders lose money. Your analysis can be on point, everything is correct, but because you fail to use the right order type, that could lead to a lot of losses. Today, we're going to be focusing on one of the most overlooked aspects of trading that is also very important, and that is understanding market order types and also executing strategies every trader must master. Welcome to VidaFX, where we make trading easy for beginners to understand. We simplify everything and make it easy. So in this video, we're going to be covering the types of order and how to use each one properly. Please remember to hit the subscribe button if you've not subscribed and give this video a thumbs up. Now, what are the different types of order we have? We have market orders, we have limit orders, we have stop orders, and we have stop limit orders. And I'm going to be explaining each one accordingly. Now, what is a market order? A market order is simply an instruction to your broker to execute immediately. You're saying whatever happens, whatever the market condition is, get me into the market now. Do you understand? It means that even if, like, it's just a noun order, do it now. Like, there is no give me 5 minutes, do it now. That is what a market order is. It can also be called instant market execution, just like your instant noodles. So it means it prioritizes speed over price precision. So Euro USD can be trading at 1.1 and you place a market buy and your order is filled instant. But the disadvantage of entering a market instant execution is that sometimes there could be slippage because of spread. I'm sure by now, if you've been following this channel, spread is not something new. Spread could bring slippage, and maybe you wanted to execute at 1,500 and there could be slippage and it execute at 1,505. So that extra 5 is your broker's fee. This is what a market execution looks like on your MT5. Now you see that sell button where the yellow arrow is pointing to. If you click on that sell, you're in the trade immediately. Same thing if you click on the buy, you're in the trade instantly. There's no delay, it takes you in immediately. So that is what instant market execution is. And most times scalpers use that a lot. I covered the types of trader on the previous video that I posted, and I talked about scalpers. So scalpers use instant market execution to place their order immediately. And let us talk about another kind of order, and it is called a limit order. A limit order allows you to define your entry price in advance. Okay, now this kind of trading, you are in charge. You're telling the market where it should take you in. There will be no slippage, there is no confusion. If price is trading at 1,500 and you want to see a retracement, you say when price gets to 1,400, that is where I want to buy. I want to buy cheaper, I want to buy at a discount area. So that is what happens. You place your limit order, wait for price to get there, and it takes you into the market. So you're only saying execute this trade at the price that I want. And we have two types of limit order. We have the buy limit and the sell limit. So this is what a limit order typically looks like on the chart or on your MT5 or on your trading platform. You can see that this is a sell limit. Price has already sold down to 0.78086. That's where price currently at, and I have placed a sell limit at 0.78190, that if price reverses to that point, take me into the sell. That is the only time I want to join the sell. And this is what a buy limit looks like. For a buy limit, I'm saying the market has already bought and gone up but I'm saying I want to wait below, or wherever there is retracement, that is when I want to join the buy. So in this kind of market, you can see it's even written there. You can see market execution, buy limit, sell limit. So if you click on any one, it's going to automatically position itself either above or below where price is at the moment. So some of these things may not be easy for you to understand, but when you go to your NT5 and practice, you're going to understand eventually with time. Another kind of order is stop order. Now, a stop order is used to enter the market when price breaks a level. You're saying if price gets here, momentum is confirmed, get me in. So in this kind of market, instead of waiting for price, let's say you want to buy at 1,000, price is currently trading at 1,500, and on a buy limit, you're waiting for price at 1,400 on a cheaper zone. Now, in this type of market, you're saying if price breaks 1,500 and starts selling to 1,550 or 1,600, get me into the market. That means the market is really going to buy. So you're saying at this point, I don't want to join the market early. I want to join it halfway when the trade is already running. And we also have different types of buy stop limit. Now we have, this is a buy stop. You can see that the market, this is GBP USD, and the market is currently trading at 1.35135. Now if it was a buy limit, I'll probably put my buy limit at 1.35008 or 1.3500, right? But in a buy stop limit, my buy limit will be at above the current market price. All right, take note, your buy stop will be above the current market price. Like I said, if price was trading at 1.5 at when you got to the market, you're saying if price gets to 1.6, that's when you want to join the buy, which means buyers are in control of the market. We also have a sell stop limit. For a sell stop limit, you're trading below the current market price. Again, if price is selling at 1,600, you're saying you will only sell when price goes cheaper to 1,500, which means the sellers are in control. So that is what a buy stop and a sell stop are. And mostly breakout traders, break and retest traders, they use this kind of orders a lot. Now, this is the most important kind of order. It is called a stop loss order. See, in anything you do, please understand what a stop loss order is. This is the most important order type. A stop loss is what protects your capital. Remember, you protect your capital, and that is what keeps you longer in the game. A stop loss order automatically closes your trade when price moves against you. Let's say you are on a buy on Euro USD and price suddenly moves with momentum downwards. A stop loss is going to protect your position and close that position automatically, whether you're on the chart or not. Sometimes there could be news event, sometimes there could just be manipulation in the market or stop loss hunt. So if you don't have a stop loss, that could easily blow your account to zero. So a stop loss order is the most important kind of order, and it is risk management. That is how you manage risk and protect your capital for you to see trade to trade another day. Not using stop loss is the same thing as gambling. Stop loss is what professional traders use to stay above others. Now, one thing, a take home, retail traders focus heavily on finding entries. Professionals focus on executing them correctly, because in the long run, execution quality determines consistency. So please make sure you understand order types, when to use them correctly, and how to use them in every market condition. I hope you learned something on this video. If you found this video helpful, please remember to like, comment, share, and drop a comment on the comment section. Thank you guys. See you in the next